Well, hello, everybody, and welcome to the Middle Class Investor. This is Seth Martin, your host. So glad that you're joining me today. I think we're at a critical juncture in the market and wanted to go ahead and make a video, talk about it. Missed making videos the last 2 weeks. There were various things that I had going on, and I just couldn't get around to it, so I apologize for that. But really, nothing's happened the last 2 weeks, and we've had I'm operating under the assumption that this is probably a bear market rally, and the reason they're so, they have an effect on the psychology of traders by sucking people in. I mean, the design of the market is really, because it's a psychological type construct or whatever, it has a tendency to fool the most amount of people the most of the time. So if you can understand that and look for certain indicators that show that, then you can kind of become not a market wizard, but just someone who doesn't get emotional about what's happening in the market. You have your plan, you have your thesis, and you have where you're going to be wrong. You know where you're going to be wrong before you even make a decision to begin, and that's the way you approach. That's the best way to approach investing, trading, things like that. So today I'm going to show you a chart on the Elliott wave, because we're going to talk about what types of things are we looking for to confirm that we're in a bear market rally and that we're not in a new uptrend. What types of things do we look for? And one of them is right here on the chart, so I'm going to go ahead and talk about it right now since it's staring us right in the face. And we've talked about this before, but it's something known as a divergence. And so the MACD, and you can use the RSI. I mean, you can use any oscillator to show these types of divergences. It just so happens that I have a MACD. It stands for moving average convergence divergence. And so I have a 2-line MACD with a histogram. That's what you're looking at right there. And the numbers I use, the fast line is an 8 period. The slow line is a 17. And the histogram uses a 9 period average, I think. So, what's happening here is, as the market, let's just talk about what's happening here in this divergence. The market made a high here, and the MACD made a high. So right here, this move up is in sync with the internals of the market. Let me see if I can get all this on one screen. Hopefully you can see this. So this peak right here coincides with this peak right here. Now, obviously, some more cards have to come out of the deck before you can tell you have a divergence. In this case, the market, it sold off and then found support and then began to rally and make a new high. So here's a new high right here. But look what happened on the MACD. The MACD failed to make a new high. So what this is telling you is that this last run up here, momentum was waning. Another way to look at it, if you also looked at the advanced decline line, so how many stocks are advancing versus how many are declining, you would see that line was falling also as you were moving up in price here. It's just another way to look at internal market strength. And then we sold off sharply in December, and then since the day after Christmas, we've been having this rally. And so this was last week, this was the week before, this is the last time we spoke. So I put I had an area where I thought resistance could be, and we pretty much blew through that. And I can talk about why I put the resistance there. It has to do with this pivot. We've talked about pivots before. and so that's why I drew it. Also because of this low, this pivot over here was kind of in conjunction with that area, so that's why I drew it there. But obviously that doesn't mean anything. If the market decides to go through that, the market can go through that. All right. Now let's one of the things I want to show you while we're in this, I'm going to take this bottom study off. I'm sorry, all that racket is, the trash is being picked up and my dog's barking at it, so apologize for that. But I'm going to go ahead and take this study off. If I can find it, there it is. And we're just going to look at price for right now, so it's a little easier to see the movements and everything. What I want to do, what I'm operating under right now, is that we've had an initial move down from the highs, and we had a retracement which turned out to be a flat, which is a wave 2, and then we've had another move down. And so this second move down, I'm saying, and there's no way to be right. Okay, I'm not right or wrong. This is just the way I'm approaching it. This is another one. So I'm operating under the fact that we've got a 1-2-1-2 kind of going on here. So where should I expect this to run out of steam? Well, what I want to do is I want to look at this latest from high to low, this latest move down. Okay, so what I'm going to do is I'm going to use my Fibonacci tool. I'm going to go over here to this A. The reason I'm going to go to A is because it's higher than this. So I just want to use the high that's from the previous structure to the low of the structure. Okay, and what you'll see is this number turns up a lot in the markets. It's 61.8%. And what Fibonacci is, maybe we should talk about that a little bit, is Fibonacci is the ratio between certain Fibonacci numbers. There's a Fibonacci sequence. It goes 1, 1, 2, 3, 5. So the way Fibonacci, in fact, let's just pull it up real quick. Fibonacci sequence. You can look this up yourself. It's very interesting. This guy, Fibonacci, was a very interesting kind of guy. And here's some, this is called a Fibonacci spiral. There's a lot going on with Fibonacci, but the way it works is, the way the Fibonacci sequence works is, it's this number plus this number gives you the next. So really it's hard to do from 0, but you can see 1 plus 1 is 2. 1 plus 2 is 3. 2 plus 3 is 5. 3 plus 5 is 8. 5 plus 8 is 13. 8 plus 13 is 21. And it goes on and on and on. Now, when you divide this number by this number, so the first number, in this case 8, divided by 13, you get a number that approaches that 0.618. Okay, so, and as you go further out, it's a limit. Okay, it reaches a limit, and it's 0.618, blah 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 blah. So in other words, if I take 8 divided by 13, it's always an irrational number. That's another interesting thing about Fibonacci. Where's my? Let me get my calculator up here. Sorry, I don't use this calculator very often. Well, maybe I can just use Microsoft Calculator. Okay, so what we're going to do is we're going to take 8 divided by 13, and we're going to get this number here. Okay, so as you can see, it's not 0.618, but as I go further out on the Fibonacci sequence, it approaches this irrational number. It's also known as phi or phi, which is 0.618. Okay, and it's a really interesting sequence because a lot of things, there's branching, a lot of things in nature follow this sequence. So for example, when you have a tree, I'm just going to give you a little taste of it here. Let's get up here to some white space. Hopefully we're not. So when you have a tree, it tends to branch off, right? And then these branches branch off. And then these little branches branch off, and so on and so forth. And so what happens when you subdivide this, when you look at, when you kind of break the tree up into parts, you can see this lower part has one item in it, right? And if I segment the tree here, then there's just one here. If I segment the tree here, you see 1, 2. If I segment the tree, and so on and so forth, if you segment the tree higher, see now I've got 1, 2, 3. And if I segment the tree higher here, if I was going to put another branch here and segment the tree higher, anyway, the further the branching goes, it follows this Fibonacci sequence. Also, the spiral, the Fibonacci spiral, is very common. And sorry about the dog and what she's barking about. There's just a ton of information on this, and you can go learn about it. But this triangle, this rectangle here, is subdivided in 1 and then 0.618. And then it turns out I forgot exactly how it works, but if you bisect the rectangle, you can continue to bisect it until the spiral spirals in infinitely this way and infinitely out this way. So anyway, there's just a lot of stuff on Fibonacci. I encourage you to investigate it yourself. But for the purpose of trading, what we're really doing is we're just it's like a measuring stick or a measuring tool. So, but after if you really study like 1, 2, 1, 1, 2, 3, 4, 5, what you'll see is that 2, a lot of times the second wave will retrace around this 0.618 area, and a fourth wave will retrace somewhere around 3.82 area. So anyway, it's just an interesting type of thing. Now, this could actually retrace the whole thing, and our theory is not invalid until it breaks this high, which is kind of a bummer, right? Because let's say you got in right here and you think, okay, I'm thinking it's going to go lower, and it keeps going higher and higher, and finally it breaks through, and then you're wrong. Okay, well, you got to make sure that you're not taking on too much risk if that's your trading plan. Okay. So anyway, this 0.618, we've broken through that some, but then we're starting to show a little weakness, and we could get a slightly higher high. I mean, we could end up taking out this high early next week, but I think this pattern is just about complete. And so the question is, okay, what comes next? Well, 3 comes next, but what you have to remember is it's a 1, 2, 1, 2. So the 3 is going to be at least 2 degrees of trend this size, okay? And it's actually been more than that because there's more than 2 degrees of trend here. There's some very small degrees of trend, but just the size of these trends could be substantial. So when you start looking at, okay, where's it going to go? Well, let me take off this Fibonacci. Gosh darn it! I hate when everything's just jumping around like that, and I can't seem to get what I'm trying to click on. But let's assume that this whole move from top to bottom is complete, and so we got 2 degrees of trend, and we want to kind of estimate. Okay, well, where is this going to go? Well, what you can do is you can use Fibonacci again, and you can this time go from the very bottom to the very top. And we can see where Fibonacci extends out. So to do that, we're going to have to go out a little bit. Let's go to a 10-year. And a pretty common area is this somewhere between 200 and 2.61%. So 3 could take us well past the 1800 area, and it may be as low as the 1400 area before this even stops. Now it's going to take several weeks to do that, but that's not an uncommon type of move for a wave 3. And I could show you that on a smaller scale. I think I'll look for a couple of examples sometime. It's hard to find it on a really large scale like this because these large scale moves don't happen as often as the small scale moves. Remember, the market is a fractal. Okay. So now what we could do is we could look at, I could look at this one, for example. This is a 1, 2 right here. So we could zoom in. We could do a Fibonacci on this, and let's just do that, and let's see where it goes. So from low to high. Whoops! I'm sorry, I went the wrong way. We want to extend it up. So the 2.61 is right here. As you can see, it went a little further than that before it pulled back. But you can see the 2.61 is a pretty good, basically once the market, so let's just zoom in here and let's talk about this a little bit. So once the market quit going down and it started to go up, it really didn't have a significant move down until after this 2.61 retracement. See that? You see it took place right here on this week. So we hit the 2.61 here on the week of July 1st, and then it really didn't have a significant move back down until October of that year. So the 2.61 is a good number. So potentially what this could have been was 3, and then we had a short 4 here, and then a 5, and then we had a pullback. Okay, so that's probably what this was. But the 2.61 is a good place to, if you're trying to figure out, okay, well, where's my target? Because if you have a target, it's easier to figure out your risk, your reward to risk. Okay, so if my target is down here, again, let's take Fibonacci and let's go from bottom to top. Whoops. And 2.61 is down here around 1400. So if I'm trying to pick a trade here, let's say buy a put, well, I can buy an out of the money put, say around 2100, and trade it all the way to 1400. So, and you can make a lot of money doing that. Now you have to estimate time and some other things. So, that's for another video. But anyway, I just want to tell you that I just wanted to chime in and talk about how complete this structure looks at this point, and that sometime within the next week or two this should roll over and start accelerating pretty rapidly to the downside. All right. Let's look at the 13-week Treasury. There's been a lot of talk about the Fed not raising rates anymore. Why is that? Why is the Fed talking about that? Well, just look at the market. We talked about this way back here when this started to break the trend, that the Fed might stop raising rates for a little while. Okay. Again, this happens and then the Fed responds. So I would say you're probably not going to hear anything more about the Fed raising rates until we break out of this structure here. Now, that could happen next week, but people think the Fed has stopped, and I'm telling you right now, if rates get to, on the short term, get to 0.245, Fed's going to start raising rates again. Certainly, I would say anywhere, if this gets above this line, or even above, let's just put it on there for our own knowledge. Let's put a little pattern here. Take that extension off, and we'll just have it on there. And I'm telling you, if this starts breaking above this structure right here, Fed's going to start raising rates again. Okay, that's just how it works. Let's look at the 10-year, and the 10-year looks like it has found some support. So if the 10-year starts moving out, in a big way. Maybe up here around this line, looks like it's going to break out. The Fed's going to raise rates on the short term as well. Now, where can the 10-year go? Again, if you use Fibonacci, okay, if this is the first move up and this is a 2, okay, which it could very well be, then let's just use Fibonacci and let's just see. So let's go from here down to here, and let's see where 2.61 is. Again, we're going to have to back out a little bit to get to where 2.61 is. We're going to have to back out a little bit more. This ought to give you a sense of how much rates are going to be going up. This is probably not going to stop until we get to around 4.7% on the 10-year. Now that's almost a doubling of interest rates from here. I'm here to tell you that is going to screw things up big time in our market. So don't be buying any bonds. I mean, I've been talking about this for a long time. Of course, right through here, you've been making money on bonds. But if this starts taking off, you're going to be losing money on bonds. So really pare that bond holding back and, maybe increase cash. Volatility's pulled way back. We had a spike right up into here, almost to this little trend line that we have. I don't even know why that trend line's there, but it almost went all the way up to the trend line, and then pulled back sharply as we've had this rally. There's a lot of, I know Peter Schiff talks about it, and a lot of people are talking about how, these foreign countries, foreign markets are better places for your money. I don't know. I don't really know because I'm not, I don't know about these foreign markets so much, but I think my personal opinion is this is going to be more of a global event. It's not going to just affect the United States. It's going to affect every country in the world, mainly because every country's been doing the same thing the United States is. Here's a 1, 2, 3 looking move. Let's just test our 2.61 deal and just see. Doesn't look like it's gone as far. Maybe only 200% on this one. No, it's only gone to the 1.61. So that happens sometimes. But this could roll over right here and head further south. I mean, in other words, this may not be the correction. This may not be the larger correction. This may be similar to what we see in the broad market, where this is maybe a 1-2, and this is kind of somewhere in here. There's a 1-2. It's hard to say, but to me, it looks. What I do see is a 1, 2, 3, and potentially a 4, and then if 5, 5 could extend way down here past the 2.618. I think just Fibonacci is pretty cool, pretty neat little tool. Use it. Don't put too much. One of the problems with people when they find a tool like MACD or RSI or Wilder's RSI or any of these things is that they find a situation where it worked, and then they think, oh, that's the holy grail, and then they really start increasing the risk, and then you blow up your account. Just don't do stuff like that, okay? Because nothing works 100% of the time. Nothing, absolutely nothing works 100% of the time. You have to kind of think about the way the market moves in probability. What's the likelihood if it's moved way down? What's the likelihood that it's going to keep falling? That's a low probability deal. The higher probability is that it's going to bounce and retrace a good portion of that move. That's just the way the market works. Nothing goes straight to zero. Nothing goes straight to the sky. All right, let's switch over to the TOS charts, and let's look at some of our commodities like oil. I've got it on a daily chart. Oil didn't quite get down to our let's put this on a weekly. It didn't quite get down to our support area, but it may still get down there. It may be making some sort of ABC, and then it's going to come down here. But that's a pretty good move. I mean, this could very well be over, and oil's it's going to make its way back up here. We'll just have to wait and see. One of the things that's hard to determine, maybe harder than direction, is timing. Like when this started to take off, could we have imagined that it was going to take, here's July of 2017 and the peak was October of 2018. I mean, could we have imagined, when this first took off, that this whole move was going to take that long? Sometimes the length of time is the more difficult thing to estimate. That's why when I do draw these triangles, and golly, I don't know why I can't get over there and see that, but one of the reasons when I draw these triangles and stuff, I try to draw a structure that's symmetric and that looks like the way the market. I mean, you can see a triangle here, and you can see the space between these moves is about the same. And of course, it gets shorter as you get to the end of the triangle, and then it makes a move. But the direction sometimes is not as hard to predict or estimate as it is how long that direction is going to last. That's just been my personal experience. In fact, let's look at the euro. The euro is a good example. I mean, the euro all through here looks like it was going to bounce, turn and start going back up. And it would consolidate and drop and then rally and then drop again. And so, again, I'm going to make a statement here. I think the euro is about done, and I think it's going to start moving out from here. In fact, but you could have said the same thing here. It fell to the trend line, moved out, but then pulled back to a lower low. So one of the things I'm going to put it back on a daily. One of the things about what's happened so far with the euro, and I just want to point it out here because this is one of the signals I look for, and one of the reasons I think it's possible that we're going to move out this time. But sometimes it takes 2 or 3 times. You got to put a trade in and you lose money, and you put a trade in and you lose money. The key is don't lose a lot, just lose a little bit. But you might be familiar with it. What I use sometimes is I look for the low of the high the low of the low day. Okay, when I'm looking for the bottom. So here's the low day right here. This day right here is the low day. And so here's the high of the low day right there. And now we've had a close above the high of the low day. Does that make sense? Okay, here's the low day. Went all the way down to here, made a new low. Now it didn't make a new low here, but it was the low of this pullback, okay? And so the market rallied and then closed above the high of that low day. Okay, this is a signal I use sometimes. Now, Monday we could gap down, into here and then rally the next day, maybe something like this, and then rally the next day. So we've had another pullback. We've had a pullback to a higher low. So all I'm saying is we've had a close above the high of the low day, and this is potentially a signal. Now, whether you just go in and buy the next day, or you wait to see if it pulls back, and then you get a close here above this is the low, this is the low, this is the low day after this pullback. It's just a way of trying to figure out, kind of fine-tune your entry. So let's say I enter right here. Well, where am I going to be wrong? Technically I'm not going to be wrong until I get here, but there's nothing wrong with saying I'm going to exit here and look for a new entry. So if this pulls back even a little further, and does one of these, well, then I exit here and then I wait for a new entry, and maybe I get a new entry right here. And this would even be a better entry because now I have I've got a low, a higher low, and then I've got a close. Here's a close above the low or close above the high of the low day. Here's the high of the low day. So this would be an entry here. Okay. And then obviously where you'd be wrong is right down here. Okay, if the market pulled back and went through here, you'd be wrong. But you can see here that your risk is much lower. Your risk now is this, instead of just buying right here. So these are just things you have to decide. Again, the downside of waiting for something like this is you might not get it. It might just take off and, you know, go up and start running away from you. But those are the things you have to decide when you're entering a position. Okay. All right. It's so funny because everybody's thinking the British pound is going to go down, and maybe it is. You know, I don't know. I got no idea. But what I do know is that we had a big pullback here. We've had a move off that low here. So let's just take our Fibonacci tool just for grins and go from high to low and see where 2.61 is. It's way up here. Way up here. And the British pound could be making new highs in the next several years. And I think most people think it's going to go lower. So again, the market tends to do the opposite of what most people think. So if you turn on the news and everybody says, oh, the British pound is going to crash, or, you know, when Donald Trump got elected, oh, well, you know, people were saying the market's going to crash because Donald Trump got elected. Well, what did it do? It took off way high to the upside. It didn't crash. So that's just the way the market is, okay? It just does stuff like that. So let's just talk about the news. The news is, oh, this whole Brexit thing is awful for Great Britain. You know, it's going to cost their economy, you know, 0.6% of GDP, and it's just negative, negative, negative. But what do we have here? We have a low. We've got a high, and we've got what looks like a higher low. I mean, let's take this Fibonacci off. If I draw a downtrend line here, let me make it more pronounced. So if I draw a downtrend line here, connecting the highs, what do I have? I've got a breakout of this downtrend line, also known as a flag pattern. So, you know, the way you do these flag patterns is you take a line from high to low, okay, and then you take this. I'm just going to copy it, duplicate it. That's what they say, and then I'm going to put it right here on the breakout, okay. And the chart says that the British pound is going 1.475. So, you know, I just think it's interesting that, you know, all the smart guys on TV, you know, are thinking the British pound's going to crater. But the chart says it's going here. So let's leave this on here. We'll see. In fact, let's just put a text note on here. Call it target. That way, when we come back, we can kind of test our idea, and, you know, depending on what happens, we'll revisit. I don't know why there it goes. We'll revisit our thesis and talk about why we thought that was. Now that's not as high as the British pound. You know, that doesn't mean it's going to stop there. That's just. It might stop there for a while. So if you were buying, let's say, an option, you know, you wouldn't want to hold it through some sort of consolidation, because let's say you bought the British pound, some sort of, I don't know, ETF or something, and you bought a put or a call option, and you took this time here from April to, you know, basically in the year. So, you know, 8 months, and you double that. So let's say you bought a leap, you know, which is more than a 12-month option. Well, if it consolidates after it reaches the target, it consolidates for 6 months. You don't want to hold that option during consolidation. You want to go ahead and sell it and then look for a new trade. Okay. So that's why I picked that target. Now the longer term target could be closer to that 1.9, you know, from remember the Fibonacci high to low mark that I did. So hopefully you're following that and you're understanding that. So is there anything else I want to talk about in here? I guess gold. Gold continues to move out, gold and silver. There was some sort of triangle consolidation here. I don't even know. It's so complicated looking, but what we believe is going to happen is this is going to go until you get into this 1450 to 1500 area, which is the pivot, or which is the decision area off of this pivot. Okay. If you look at it, this is all one swing right here. Even though there's little swings in here for when you're looking at a daily or a weekly. Let's just look at a weekly chart. It's easier to see on a weekly. This is a unique swing here, high and low. But then this is all just one swing, this whole move here. And then this is unique, right? Because it broke out of, if you draw a channel through here, just trying to get you to help you see, patterns and things like that. But if you notice here, there's a channel here. So this is all one swing. But then once we broke out of the channel, this is a new swing. Okay, this is a new swing. And so what we want to do is we want to go off the pivot that was from the low to the most recent high. This pivot right here is the important pivot. Okay, and this decision area is drawn off of this pivot right here. Okay, so we're going to look for gold and silver to kind of make its way up into this area. Okay, these pivots are very helpful. If you go to the big low and you draw a line up where it stopped and started to come down, that's an important high right there. This high right here is an important high. Now, when we come back down this way, what's going to be the important low? Is it going to be this one? Yes, it can be this one, especially if it makes a new high. If this makes a new high, then this was the last swing into the high, and it originated here. So this is going to be our decision area coming back down if it makes a new high. If it doesn't make a new high, this will be our decision area. This one right here. Let me get that off there. So if it makes a new high, this will be a decision area. If for some reason it just comes up to here and rolls over, then this will be our decision area right here. This will be the pivot where we draw our decision area. Hopefully that's not confusing. It takes a while to, I'm saying it pretty fast, but it does take a while to get used to that, to identifying those areas on the chart. So right now, this is the important high and this is the important low. But clearly, if we make a new high and then start to pull back, then this is going to be the important high. This will still be the important low, but this will be the new important high. Okay? Again, hopefully that's not confusing. Let's look at silver real quick. Silver's, it's not moving as quickly, but silver can move very, very quickly. I mean, it can really start giddy up and going here. So now let's look here. This was the swing into the low. Okay, so this is an important low. And then the move off the low, and then the return. So this is the important high, the most recent important high. So we're saying silver is going to at least go to $22 from where it is right now, $15, so $7 increase in silver. But it could go much higher. It could go as high as this. It could go as high as $26. So anyway, that's silver. All right. One of the things I want to point out, I want to just take you to, I did, and I'm going to pick this back up probably next week, but I did a quick little training on support and resistance and trend. Trend is the first one, support and resistance is the second one. I'm probably going to talk about these swings, the swing high, swing low stuff. I want to talk a little bit about volume, but I'm gonna put these on here as like training classes. Okay, so feel free to save them to your computer or whatever, screen capture them or something, and just go back every now and then and review the basics. Okay, trading is all about the basics. It's all about, that's really all the knowledge you need is in the basics. The rest of it is all about managing your own psychology and managing risk. That's really all it is. So with that, I'm going to end today's session. And of course, if you have any comments, you can, the way that works, there's a comment section below each one of these videos. And then I think I get something up here that tells me that I have comments. So I've got 21, but sometimes these are just notifications about stuff that I've subscribed to. So anyway, I hope that helps everybody this week. Again, just to recap on the S&P 500, the structure is about complete. We might see a little bit higher high. It might poke up above this and then immediately start selling off. But we should see some selling start next week. Some fear creeping back in. The VIX going back up. All that should happen starting next week. Okay. All right, everybody. Hope that helps. Hope you're saving. Hope you're not losing a lot of money. You're making money in your 401k, but that you're cautiously optimistic about the future of your 401k, given what we've talked about here. All right. Thanks for coming in, everybody. We'll talk to you next week. Bye-bye.